Before we discussing income tax, let's review the three sets of reporting rules. Option 1, cash accounting. Option 2, accrual accounting. Option 3, tax reporting. In option 1, we actually prepare a statement of cash flows, which focuses on cash inflows and outflows for three different business activities: operating, investing, and financing. Option 2, accrual accounting, captures business activities, which is independent from cash flows. You all know that. And option 3 is tax reporting, which is regulated by the IRS. Different rules, different purpose, we get different numbers. Okay, now income tax. We know tax is part of expense. We report it in the income statement. Also, when company pay tax, they also prepare another reports for IRS. Actually, the tax expense and the accrual accounting is not equal to the income tax owed, which is tax payable or cash payment to the IRS. The reason is they treat the revenues and the expense differently, and there's two fundamental reasons for their difference. One is permanent difference. The other is temporary difference. That's because of different regulations. Okay, so what's the difference? What's a permanent and temporary difference? The permanent difference is some item is recognized in the financial statement, actually accrual accounting, but not in the tax reporting. For example, some tax-exempt revenue items, non-deductible fines and penalties. For example, the interest earned from municipal bond is actually tax deductible. So it is not reported as revenue in the tax report, but it is a revenue recognized in the financial statement, particularly income statement. And this difference will not be reversed, so we call it permanent difference. The other is temporary difference. Basically, temporary difference is a timing difference. Okay, sooner or later, the effect will be reversed. Okay, both financial report and tax report will be the same. Okay, for example, depreciation, warranty expenses. And we also have examples to discuss what's the permanent difference and temporary difference. We have two approaches. In this class, I just introduced income statement approach as an example. Balance sheet approach is very similar to the income statement approach. Also, here is a formula between the financial reporting, income tax expense, and income tax on taxable income. But their difference is actually deferred tax liabilities, or the changes in deferred tax liabilities and the deferred tax assets. Okay, pay attention. The difference between these two are the temporary difference. We record it as either the changes in deferred tax assets and deferred tax liabilities.